You're listening to The Moose and the Loose, your 10 minutes action-packed financial podcast with your host, Mikey Hu. Hey, what's up, Market Moose? Mike from The Moose on the Loose. Happy Monday. I hope that you had a great weekend. And we're going to start the week strong with the big question about Magna International. Can it make a comeback? I mean, that's kind of crazy, right? Magna International has been dead money for a while. So this iconic 5% yielder company may attract you with this generous yield and may attract you with this lovely investment thesis. We're going to talk about that today. But if you've been a shareholder of Magna, you've been on the break for a while. Yes, pun intended. So year-to-date returns minus 12, 3 years minus 23, 5 years 2.5% up. Wow. And that includes the dividend all the time. Total return, right? So not even matching inflation, like nothing for the past 5 years. So let's go 10 years, just to make sure that we have like a complete picture. Minus 4% in 10 years. And I share your pain because I was once a shareholder of Magna International. I bought it in 2017. So from 2017 to 2018, I was super happy. Then it went back down pretty much into like no man's land, just like dead money, not making money, not making profit. And then it made a big jump in 2021, rise of the EVs, right? So electric vehicles, everything was crazy. The stock traded above 100, almost at $120 actually, and then went back to kind of like dead money land around like $70 or something. And then I sold it, if I remember correctly, in 2024, pretty much made like 5-6% profit plus dividend on it. So, I mean, that was, yes, I did not lose money, but that was definitely not a good holding, especially when you compare how much money I would have made just investing in the stock market instead. So what's the problem here? So we're going to start about the investment thesis. So we're going to look at the playbook, the growth vectors, the moat. We're going to look after that at the dividend triangle, the risk, and we're going to see if it can make a comeback, because you'll see the investment thesis is actually quite seducing. So the playbook, Magna International is one of the largest auto part maker in the world. They have a very strong relationship with all the car makers. So we're thinking like GM, Mercedes, BMW, other big guys from Detroit like Ford, for example. GM's making like 14% of their revenue. Very, very, very strong relationship there. They make so many different auto parts that they could actually build their own car, which is kind of crazy. They are particularly good with lightweight vehicles. So, and we are thinking about like trying to, like more economical vehicle, electrical vehicle, EVs as well. We'll use like lightweight parts. So they're a major player there. So that's what they do. In terms of growth vectors, well, of course, because they have strong ties with a lot of car makers, one of like their key growth vector is to sell more parts or more units to each of those car makers, right? Just trying to do like cross-selling opportunities, growing by acquisitions and offering new parts all the time. The EV opportunity is still there. There is definitely a higher need for powertrain and battery tray segments, but the old electric vehicle trend kind of fade out a little bit over the past 2 years. And now, while they will continue to think it's a growth vector, we're not seeing that much growth actually at this place. So we're not too sure what's going to happen. In terms of economic moat, well, Magna International has a very deep interaction with the supply chain of those automakers, right? So it makes it harder to shift. It's kind of like a sticky business, which is great. But on the other side, they also face a lot of pressure to reduce costs for all of those parts. So car makers are like big buyers, and they're using that buying power as a negotiating tool to get better prices. So while, yes, Magna International has a strong bond with them, it always comes with a counterpart. When you look at the dividend triangle, so those three magical metrics that will actually tell you if the company is doing well or not, or if the investment thesis actually makes any sense or not. So we're looking at revenue, earnings per share, and dividend growth trend. So the revenue, well, obviously, big surprise here. It's related to the automotive industry, so it is quite cyclical. It goes up, it goes down, nothing to worry about here. It's just normal. One thing I have a problem with, though, and that was like the reason why I eventually sold my shares of Magna International, is the shaky earnings per share. So while revenue are cyclical, earnings are having a tougher time to show growth. Most of the time, it's because they're manufactured, they're great when they work at full capacity, but whenever there's a down cycle, well, then it's quite capital intensive to maintain those manufacturers up and running, even though they are not running at full capacity. So margin get hurts, and over time, this is what I've noticed with this one while reading quarterly earnings one after the other. The margin is the nerve here, and it's not stable. It goes up, it goes down. They're having a lot of difficulties to maintain them, which means that they have a hard time to generate higher earnings per share, and this is where it kind of sucks, and kind of explain why the stock price does not go up. It's because the earnings per share does not go up. I mean, totally makes sense here. I mean, it's not like voodoo or magic. When a stock price goes up, it's either expectation or it's numbers. In this case, the expectations are not high enough, are not strong enough to boost the love for Magna International, and the numbers are not justifying any kind of boost. Finally, the dividend trend is slowing down. Yes, Magna International is a dividend grower. Keep in mind, it pays its dividend in US dollars, so you need to look at the US dividend trend, not the Canadian one, because then it will be influenced by currency fluctuation. So 2% last year, 3% annualized growth rate over the past 3 years. So it's not the mid-single, high single-digit dividend growth rate that we used to have with Magna International. That slowed down. That was another reason why I sold. When I saw that, I'm like, yeah, that's been a few years now that the dividend is not that great. The earnings per share are shaky. If I follow my methodology in the dividend income for life guide, it's not a keeper, and this is what I did. I just get rid of it because of those reasons. If you want to know more about how to set up your investment thesis and follow low yield, high growth stocks, you can download the dividend income for life guide at moosemarkets.com/income. So it's moosemarkets.com/income. So in that guide, you will understand definitely why I sold Magna International. Having said that, the dividend is safe at this point. The payout ratio is around 50%, so very decent, but slowing down. So it's definitely a concern. So when you have a company that now offers a yield above 5% and you see the dividend now matching the inflation, and that's pretty much it, well, even though the payout ratio is not catastrophically high, it's a lot of red flags, especially for a cyclical business. And now it's time to talk about the risk and the expectation if Magna International can make a comeback. So business vulnerabilities, they need high volume. They need to run those manufacturers at the highest pace possible to be highly profitable, having great margin, and then making a lot of money, which, because the business model is quite cyclical, does not happen all the time. Actually, quite the opposite, in fact. So that's why the earnings, the dividend triangle is not able to kind of find, when you're looking at a boat that is about to sail and get the winds, well, it's never getting the winds. I mean, the earnings per share right now are still lower than what it was in 2018. That's not good. I mean, the COVID cannot explain everything forever, right? We're past the change supply disruption. We're past the COVID. We're past all of those things and still having a problem. And now we have industry and market threats that are coming up. So, of course, I told you already, it's quite cyclical, but now with the looming of the tariff war, and we don't know exactly on which foot we have too dense. It's getting complicated. There's a lot of competition. There's a lot of pressure on margin because car makers are in the same problem, cyclical tariff wars. They don't know what to do. So one thing that they can do is that they can squeeze their supplier as much as they can. And this is what they're doing. They just want to make sure that they can survive, right? And in terms of competitive landscape, well, there's plenty. There's plenty of car makers. There's a lot of auto part makers as well. So there are a lot of competition. Competition is fierce. And a lot of those pieces and parts, I mean, they're commoditized. So it's going to be like the cheapest one that will win the contract as well. So that makes Magna's life very difficult. And for those reasons, I don't regret selling it about a year and a half ago. And I don't see it necessarily coming back. I mean, to come back, Magna International needs to find a way to maintain margin. So when they have great years of revenue growth, they can show strong earnings growth as well. This is not what we see. We see a highly volatile stock that goes up, that goes down on a whim, and the numbers do not justify the comeback. So if you're hoping for this, you may hope for a while, because I'm not seeing this right now, especially not where we're like walking on a thin line of, are we going to get in a recession or not? I mean, you may want to buy it thinking that it's going to come back later on if you're very patient. I'm not saying it's not going to happen, but I prefer to find companies that continually grow even during bad times. That makes my life easier as an investor, and that also offers better returns. This is also what I explain in the Dividend Income for Life guide that you can download at moosemarkets.com/income. All right, Moose, that's enough for today. Tomorrow, it's Canada Day. So I'm going to talk about some of my favorite Canadian stocks. And of course, I'm not going to cover the Québécois one because I did that last week with the Saint Jean-Baptiste episode. All right, Moose, take good care. We're going to talk tomorrow. And until then, don't forget to stay invested. Hey, welcome to the disclaimer. If you're listening to The Moose and the Loose, you cannot really expect me to give you buy or sell recommendation or financial advice, right? You're here for fun, you're here for information and some entertainment. But I am not your financial advisor, I am not your broker, so therefore I'm not liable if you're losing money after listening to the podcast. If you're looking for some advice, go see a professional. If not, you can enjoy this show and do your due diligence after it.